Hey everyone, this week I'll focus on interest rates and cap rates. Since the end of July last year, the interest rate on the 10-year Treasury has almost tripled. That's a pretty dramatic statement, but I do need to concede that last July the 10-year Treasury was effectively at an all-time low, near 50 basis points, and it has moved up to a still low 1.5%. This is important for a couple reasons. First, interest rates are still very low by historical standards, and that's good for investors. Second, there's been upward pressure on interest rates for the last 6 months. As I shared in videos over the last couple weeks, economists have been increasing their economic forecast for 2021, with some forecasts even moving into the 8% range. Normally, that kind of growth, especially when fueled by trillions of dollars of stimulus, will put upward pressure on inflation. And of course, the counterbalance to inflation is to push interest rates up. But that said, inflation remains exceptionally low. Core inflation, which excludes food and energy, remains very tame at just 1.3%. As a reminder, the Fed generally wants to see inflation in the 2% range, so they have some room to work with for now. So what's causing interest rates to go up? Falling uncertainty and expectations of growth. Because we can see the light at the end of the pandemic tunnel and the financial market expects economic growth to be particularly strong in 2021, money is flowing out of the safe haven investments like bonds and treasuries and into growth investments like the stock market and, yes, real estate. That flow of money is putting upward pressure on interest rates. Now, a lot of real estate investors believe that cap rates move with interest rates. But when you look back at the historical data, that has not held true. Yes, over the long term, measured in decades, both interest rates and cap rates have trended lower together. But when you look at the year-to-year movement, the spread between interest rates and cap rates narrows and expands. Back in 2007, when there was a significant inflow of capital coming to real estate, the yield spread narrowed to just 200 basis points. Then, during the financial crisis and early recovery, spreads opened up to about 580 basis points. Interest rates went down and cap rates went up. Now that brings me back to the here and now. As I mentioned earlier, economists have a very bullish economic outlook for 2021. Liquidity is good and interest rates are still very low. Investors are increasingly less fearful of the pandemic, and we're seeing movement into growth and yield investments, including real estate. This implies that even if interest rates rise, it probably won't push cap rates up. In fact, an argument could be made for downward pressure on cap rates, most notably for popular assets like industrial and apartments, as well as recovery property types like hotels, seniors housing, and even retail. Just a couple months ago, the yield spread between interest rates and cap rates was 540 basis points, but rising interest rates have narrowed the spread to a still wide 480 basis points. I encourage every investor to set aside the idea that interest rates and cap rates will move together. Focus instead on the outlook for each asset. What's on the horizon for demand drivers and supply risks? That combination can put the long-term context of an asset in much better perspective.